Try purchasing silver at $76. Why dealers are laughing. February 14th, 2026. Bloomberg says silver closed at $76. Every futures terminal from Chicago to Shanghai flashes the same number, $76 per ounce. Now, go to any dealer, APMEX, SD Bullion, JM Bullion, try to buy 1 ounce at that price. You can't. $85, $87, $90 on some sites. The price crashed. The premium exploded in 12 hours. Dealers raised prices on a falling market. They're laughing because they know something the screen isn't showing you, the gap between what silver costs and what you can actually buy it for. Just became a $9 to $14 crime scene, and the yellow tape hasn't even gone up yet. Welcome to Financial Crisis Explained, the only place where numbers tell the truth. Your broker won't. Now, a small request. You know how your grandfather used to say, write it down before you forget. That subscribe button below, think of it like that, 1 click, and you won't lose this channel in the algorithm's memory hole. YouTube's been burying precious metals content since the Senate hearings last month. So, do an old-fashioned favor. Hit subscribe, ring that notification bell, consider it your insurance policy against information blackout. And one more thing, drop a comment right now. Tell us where you're watching from. New York, London, Mumbai, Sao Paulo. Because what's happening in silver markets isn't happening in isolation. It's global, and we need to know who's seeing what from where. Now, let's talk about why your screen is lying to you. It is February 14th, 2026, and a simple experiment reveals a fracture in the global financial system that most investors cannot see because they are looking at the wrong screen. The assignment is straightforward, almost elementary in its simplicity. Purchase 1 ounce of physical American silver eagle at the spot price published by every major financial terminal on Earth. Bloomberg terminals display $76. Kitco reports $76. Reuters flashes $76. Every futures exchange from the Chicago Mercantile to the Shanghai Futures Exchange confirms the same number, $76 per troy ounce. Friday's closing price, this is not disputed data. This is the official global consensus on silver's value. Now comes the experiment's second phase. Open a browser, navigate to APMEX, the largest precious metals dealer in North America. Search for American Silver Eagle, 1 ounce, current year. The price, $85.50, not $76. Try SD Bullion, a competitor with comparable inventory and reputation. $87 for the identical product. JM Bullion, another major player in the physical metals market, $89.95. A smaller Texas-based dealer known for competitive pricing, $90 even, with a note that the price was adjusted 12 hours ago. 12 hours after Friday's closing bell, 12 hours after the so-called crash. The pattern is not isolated, it is universal. Every dealer, every platform, every physical source displays the same structural impossibility. The spot price says $76. The actual purchase price ranges from $85 to $90, a $9 to $14 premium. On a day when the price allegedly fell, this is where traditional market theory encounters a brick wall. In functional markets, falling prices reduce premiums. Increased supply lowers costs. Decreased demand creates buyer advantages. Basic economics, supply and demand, the foundation every business student memorizes in their first semester. But here, the inverse is occurring. The spot price declined throughout the week. Yet the premium expanded, widened, grew larger with each passing day. On Monday, the premium stood at $6 over spot. By Wednesday, $8. Friday's close, $9 to $12 depending on the dealer. And now, Saturday morning, $14 on some platforms. The price is falling, and the cost of actually acquiring the metal is rising. Historical context makes this anomaly even more striking. In normal market conditions, premiums on American Silver Eagles range between $2 and $4 over spot. This covers minting costs, dealer margins, transportation, and standard markup. $2 to $4, industry standard for decades. February 2026, $9 to $14, a premium expansion of 300 to 400% above historical norms. During a price decline, the documentation is meticulous, verifiable, repeatable. At 9:47 a.m. Eastern on Saturday, February 14th, APMEX inventory shows 473 American Silver Eagles available at $85.50. The website timestamp confirms the price was last updated at 11:23 p.m. Friday, 3 hours after market close. SD Bullion's inventory page, last refreshed at 1:15 a.m. Saturday, shows 612 coins at $87. A pattern emerges across platforms. Dealers are not lowering prices to match the falling spot. They are raising them aggressively in the hours following the decline. The Texas dealer mentioned earlier, his website shows a price history log, a feature uncommon among competitors but invaluable for this analysis. Thursday's price, $82. Friday morning, $83.50. Friday evening after market close, $87. Saturday morning, $90. A systematic escalation, in direct contradiction to spot price movement. Why would a rational dealer increase prices when the underlying asset is falling? Why would sellers demand higher premiums during a crash? Traditional market theory offers no explanation. But market structure, the architecture beneath the surface, the machinery that most investors never examine, reveals a different story entirely. And the dealers are not confused. They are not irrational. They are not manipulating retail buyers for marginal profit. They are laughing because they can see what the spot price cannot show. The difference between a number on a screen and metal in a vault, the gap between a futures contract and a coin you can hold, the chasm between paper promises and physical reality, and that gap in February 2026 is widening at an accelerating rate. The question is no longer whether this divergence exists. The question is, what happens when everyone else notices? There exists a peculiar characteristic in modern financial markets that few outside the trading floors understand. The price of silver is not determined by silver. It is determined by contracts, legal agreements, digital entries, and clearinghouse ledgers. Promises to deliver silver at some future date to someone who will likely never take delivery. This is not conspiracy theory. This is market architecture. Documented, regulated, and entirely legal. The COMEX, the dominant silver futures exchange operating under CME Group, processes approximately 150 million ounces of silver in paper contracts every single trading day. 150 million ounces. Global mine production, the actual physical extraction of silver from the earth, totals approximately 825 million ounces per year. Simple mathematics, 150 million ounces traded daily, multiplied by 252 trading days annually, equals 37.8 billion ounces in annual paper trading volume, 37.8 billion ounces of contracts, 825 million ounces of actual production. The paper market is 46 times larger than physical supply. 46 contracts claim ownership of every single ounce that will be mined this year, but the structure grows more fascinating. Of those 150 million ounces traded daily, actual physical delivery occurs on less than 2% of contracts. Less than 2%. The remaining 98% cash settled, rolled forward, closed before expiration, never touching physical metal. This is not malfunction. This is design. Futures markets were created for legitimate hedging, miners locking in future prices, manufacturers securing supply, industrial users managing input costs. But somewhere between 1980 and 2026, the futures market stopped being a price discovery mechanism for physical silver and became a standalone financial instrument, a casino where the chips represent metal that doesn't need to exist. The historical precedent illuminates the danger. March 1980. The Hunt brothers attempted to corner the physical silver market. They took delivery, actual metal, withdrawing supply from the system. The price spiked to $50 per ounce, equivalent to approximately $180 in 2026 currency. The exchanges responded by changing the rules mid-game, limiting position sizes, increasing margin requirements, banning new long positions. The Hunts were crushed, declared bankruptcy, and the lesson was learned. Never again would the system allow physical delivery to disrupt paper pricing. April 2011. Silver touched $49, approaching the 1980 peak. Within days, CME raised margin requirements 5 times in 8 days, from $9,000 per contract to $21,000, a 133% increase. The price collapsed, falling 30% in 4 days. No fundamental change in supply, no discovery of massive new deposits, just a margin adjustment. March 2020, COVID-19 market disruption. Premium spiked to $8 over spot as refineries closed and transportation networks froze. But this was temporary. Supply chain disruption, understandable, correctable. February 2026 is different. No refinery closures, no transportation breakdown, no pandemic lockdown. Yet premiums are higher than the 2020 crisis peak and widening. The current market architecture reveals why. CFTC data from January 2026, the latest available, shows commercial traders, primarily large financial institutions, holding net short positions of 230 million ounces. 230 million ounces. These are not miners hedging production. Miners produce 825 million ounces annually. They cannot hedge 230 million ounces. They will never produce. These are financial institutions selling silver they do not have to buyers who will not take delivery at prices determined by contracts that will expire worthless. This is the technical definition of naked short selling, creating supply through contracts rather than metal. Regulatory framework exists. CFTC position limits supposedly prevent excessive concentration, but enforcement remains theoretical. In 2020, JP Morgan paid over $900 million to settle charges of precious metals market manipulation spanning nearly a decade. The settlement represented years of spoofing, layering, and price suppression. Yet the structural incentive remains unchanged. Banks profit from volatility, from spread capture, from financing both sides of paper trades. Physical delivery, actual metal leaving vaults, disrupts this model. So the system evolved to discourage it. ETFs emerged as the solution. Silver ownership without delivery complications. SLV, the largest silver ETF, holds approximately 500 million ounces. Theoretically, the structure operates on allocated and unallocated storage. Allocated, specific bars assigned to specific investors, serialized, audited, expensive. Unallocated, pooled storage, no specific bar ownership, cheaper, more flexible. Most retail ETF investors hold unallocated claims, multiple investors claiming the same pooled ounces, fractional reserve banking applied to precious metals. The prospectus disclaimers are remarkable. SLV's legal documentation states clearly, the trust may not be able to acquire sufficient silver, custodians may not segregate metals adequately, investors may not receive full value in liquidation scenarios. Legal protection for the structure, not the investor. This creates the fundamental disconnect visible in February 2026. Spot price reflects paper contract trading. Future settlement, ETF share pricing. Physical premium reflects actual metal availability, refining capacity, transportation reality, vault inventory. Two separate markets, connected only by theory, and theory is breaking down. Because eventually, someone asks for delivery. Someone decides the paper promise is insufficient. The ETF structure too fragile. The counterparty risk too severe. And when enough market participants make that decision simultaneously, the 46-to-1 leverage ratio becomes a problem. The dealers in February 2026, raising prices as spot falls, are not confused. They are pricing reality, not theory. They are charging $14 over spot because spot is fiction, and fiction cannot be delivered in a vault. There is a principle in intelligence analysis that applies equally to financial markets. When official statements diverge from observable actions, ignore the statements, watch the actions. February 2026 presents a masterclass in this divergence. Public commentary from major financial institutions emphasizes silver's limited investment appeal. Analysts publish research notes citing oversupply concerns. Rating agencies maintain neutral recommendations. Media coverage remains minimal. Meanwhile, in the physical market, something entirely different is occurring. The Bank of International Settlements, the central bank for central banks, publishes quarterly data on official sector precious metals activities. Fourth quarter 2025 data, released January 2026, shows a fascinating pattern. Central bank gold purchases, 627 tons, highest quarterly accumulation since 1967. Central bank silver purchases, 0, not low, 0. Official sector institutions are buying gold at record pace, while completely avoiding silver. This absence is the signal, because central banks, sovereign wealth funds, treasury departments, they do not speculate. They preserve wealth across generational timeframes. They hedge systemic risk. They position for currency transition scenarios, and they are choosing gold exclusively, publicly, reportably, which raises an uncomfortable question. If silver serves similar monetary functions as gold, trades in the same markets, responds to identical macro pressures, why the complete official sector absence? Two possibilities emerge. Either silver holds no strategic value, making it irrelevant to sovereign planning, or silver holds immense strategic value, making official accumulation too revealing to conduct publicly. The industrial demand data suggests the latter. Solar panel manufacturing capacity globally expanded 43% in 2025. Each gigawatt of photovoltaic capacity requires approximately 25 tons of silver. China's announced solar targets for 2026 through 2030. 3,000 gigawatts of new capacity. 3,000 gigawatts, 75,000 tons of silver. Over 5 years, that is 9% of total global silver supply, dedicated to a single application in a single country. Electric vehicle production compounds this demand. Legacy internal combustion vehicles, 30 grams of silver per unit. Full electric vehicles, averaging 65 grams. High-end models using up to 90 grams. Global EV production targets for 2026, 18 million units, 18 million vehicles, 65 grams average. 1,170 tons of silver. 5G infrastructure deployment adds another layer. Each 5G base station requires 3 to 5 times the silver content of previous generation 4G equipment. United States alone, planning 500,000 new 5G installations by 2027. Europe, 400,000. Asia Pacific, 1.2 million. Medical applications, particularly antimicrobial coatings and post-pandemic healthcare infrastructure, consume additional hundreds of tons annually. The mathematics become uncomfortable. Industrial demand alone, independent of investment, independent of monetary functions, is approaching inelastic territory. These applications cannot substitute alternative materials without performance degradation. Solar efficiency drops with copper or aluminum replacement. EV charging speed decreases without silver conductivity. 5G signal quality degrades with inferior metals. Industry cannot simply choose cheaper alternatives. Yet supply responds slowly, if at all. Primary silver mining, extraction where silver is the main target, accounts for only 30% of global production. 70% arrives as byproduct from copper, lead, zinc, and gold mining operations. When copper prices fall, silver production falls. Regardless of silver demand, the metal's price has minimal impact on 70% of its supply. This is economic inelasticity rarely seen in commodity markets. Demand growing exponentially, supply structurally constrained, yet price declining. The contradiction demands explanation, and the explanation sits in institutional short positioning. January 2026, CFTC Commitment of Traders Report, the weekly snapshot of futures market positioning, commercial traders, the category including major banks and financial institutions. Net short 230 million ounces, but concentration metrics reveal deeper structure. 4 largest traders. Net short 147 million ounces, 64% of total commercial short interest, held by 4 entities. 8 largest traders, net short 193 million ounces, 84% concentration. This is not hedging. This is not market making. This is not legitimate commercial activity at diversified scale. This is structural price suppression by concentrated institutional actors. The 2020 JP Morgan settlement established legal precedent. $920 million in penalties for systematic manipulation spanning 2008 through 2016. The Department of Justice described thousands of episodes of unlawful trading in gold and silver markets. Spoofing, placing orders never intended for execution, creating false price signals, manipulating settlement prices. Yet the structural incentive remains. Banks profit from volatility, from client flow, from derivative pricing spreads, stable rising precious metals prices, threatened bond markets, currency stability, the debt-based monetary system. So suppression serves multiple institutional objectives. And it works until physical delivery becomes the constraint. Because you cannot deliver a short position that was never backed by metal. High net worth allocations tell another story beyond official data. Family offices, managing wealth for ultra-high net worth individuals, operate outside public reporting requirements. But industry surveys, confidential manager discussions, allocation trend analysis reveal a pattern. 2023 average precious metals. Allocation among family offices, 4.2% of portfolio. 2024, 6.1%. 2025, 8.7%. And within that allocation, gold to silver ratios shifting. Traditional allocation, 90% gold, 10% silver. Current emerging allocation, 75% gold, 25% silver. The sophisticated money, the multi-generational wealth, the capital that survived previous currency transitions, is increasing precious metals exposure and tilting toward silver, quietly, without announcement, without media coverage, because sophisticated capital does not telegraph positioning before completion. February 14th, 2026, becomes a data point in a longer pattern. Spot price declining, physical premium expanding, official sector absent, industrial demand accelerating, institutional shorts concentrated, sophisticated money accumulating quietly. These variables do not coexist in stable equilibrium. They coexist in pre-crisis tension. The question is not whether tension resolves. The question is when and how violently. Because history shows markets can remain irrational longer than investors can remain solvent, but they cannot remain irrational longer than physics allows. And physics dictates you cannot deliver what does not exist. The purpose of analysis is not prediction, it is preparation. Understanding that February 2026 represents a structural anomaly does not tell an investor what will happen next. It tells them what conditions now exist, what variables are in motion, what scenarios have higher probability than consensus assumes. The decision framework begins with risk assessment, not opportunity pursuit. Scenario 1, continued divergence. Spot prices remain suppressed through futures market activity. Physical premiums continue expanding as industrial demand absorbs available supply. The gap widens to $20, $30, $40 over spot. In this scenario, physical holders maintain purchasing power. Paper contract holders experience continued value erosion. ETF investors face potential liquidity constraints during redemption attempts. Probability assessment based on current trajectory, moderate to high. This can persist for months, possibly years, as long as industrial users accept premium pricing and retail investment demand remains modest. Scenario 2, physical delivery squeeze. A major industrial user, a sovereign wealth fund, or a coordinated group of investors demands physical delivery on contracts that cannot be fulfilled. Exchanges implement cash settlement, position limits tighten, premiums spike to multiples of spot price. Historical precedent, March 1980, April 2011, March 2020. Each resolved through rule changes rather than actual delivery, but each successive crisis required more aggressive intervention, larger margin increases, faster regulatory response. System's capacity to absorb delivery pressure diminishes with each cycle. Probability assessment, low in the immediate term, rising exponentially with time. Once triggered, resolution occurs rapidly, measured in days, not months. Scenario 3, regulatory intervention. Government agencies, responding to market dysfunction or political pressure, implement position limits, restrict short selling, mandate physical backing for paper contracts, or suspend trading entirely. Precedent exists. Nixon closing the gold window in 1971. FDR's Executive Order 6102 in 1933 requiring gold surrender. Governments intervene in precious metals markets when monetary stability is threatened. Probability assessment increases with macroeconomic stress. Current debt levels, deficit spending, currency debasement concerns create conditions where intervention becomes more likely. Scenario 4, currency devaluation acceleration. The Federal Reserve, facing unsustainable debt service costs, accelerates monetary expansion. Real interest rates remain deeply negative. Purchasing power erosion becomes undeniable to mainstream awareness. Precious metals respond as they have in every historical currency crisis. Price rises in nominal terms while representing stable purchasing power in real terms. This is not profit. This is preservation. Probability assessment, high over medium to long term. The mathematical impossibility of servicing a 120% debt to GDP without monetary expansion makes this scenario nearly inevitable. Timeline remains uncertain. These scenarios are not mutually exclusive. They can occur sequentially or simultaneously. The dealer premium serves as a real-time information signal for scenario probability. When premiums expand during spot price declines, physical market participants are pricing scenario 2 or scenario 4 risk. When premiums compress despite rising spot, physical availability improves and delivery risk decreases, creating a systematic tracking methodology. Record weekly premium data from 3 to 5 major dealers. Calculate average premium as percentage of spot. Track rate of change, not just absolute level. A premium moving from 4% to 6% over 3 months. Gradual supply tightening, manageable. A premium moving from 6% to 12% in 2 weeks. Acute stress signal, possible precursor to delivery constraints. Correlate with other financial stress indicators, Treasury yield curve inversion, credit default swap, spreads on major banks, volatility index movements, dollar index weakness, when multiple stress indicators align with expanding physical premiums. Scenario probability shifts significantly. Practical acquisition strategy becomes relevant only after risk assessment is complete. Dealer selection criteria extend beyond price. Reputation matters. A dealer operating continuously since 1980, surviving multiple market cycles, demonstrates operational resilience. Delivery time matters. A dealer quoting lowest price but delivering in 6 weeks versus slightly higher price with 3-day delivery. The latter provides certainty in volatile conditions. Verification protocols matter. American Silver Eagles carry government mint guarantee. Generic rounds require assay verification. Bars need recognized refiner stamps and serial numbers. Storage considerations require careful analysis. Allocated storage, specific serialized bars assigned to specific investor. Custodian holds your metal, not pooled assets. Higher cost, but eliminates counterparty risk within the storage facility. Unallocated storage, pooled metal, lower cost, but reintroduces fractional reserve risk, multiple claims on same ounces, exactly what creates problems in ETF structure. Home storage eliminates custodian risk, introduces security and insurance considerations, requires safe, insurance policy review, disclosure implications for estate planning, offshore storage, jurisdictional diversification, protects against domestic confiscation scenarios, adds complexity, regulatory reporting requirements, higher costs. No single solution is optimal. Diversification across storage methods reduces concentrated risk. Position sizing follows classical risk management principles. Precious metals function as insurance, not speculation. Insurance premiums are sized to cover potential loss, not maximize potential gain. A portfolio facing currency debasement risk, inflation erosion, or systemic financial instability might allocate 5 to 15% to physical precious metals, not 50%, not 70%, 5 to 15%, enough to preserve purchasing power if scenarios 3 or 4 materialize, not so much that opportunity cost becomes destructive if scenarios 1 or 2 persist. Timeline considerations separate strategic positioning from panic buying. Previous physical delivery squeezes, 1980, 2011, 2020 showed acceleration patterns. Initial premium expansion, gradual, 3 to 6 months. Acute phase, rapid, 2 to 4 weeks. Resolution, immediate, days. The strategic window exists during the gradual phase, before mainstream awareness, before retail panic, before dealer inventory depletes. February 2026, with premiums at $9 to $14 over spot, may represent early to middle gradual phase. Still time for methodical positioning, but window is narrowing. Building positions incrementally, dollar cost averaging into physical metal, reduces timing risk, spreading purchases across 3 to 6 months. Captures average premium rather than betting on single entry point. Professional network intelligence provides asymmetric information advantage, establishing relationships with reputable dealers beyond transactional, regular communication, understanding their supply chain, inventory turnover, customer demand patterns. Dealers see order flow before it appears in price. They know when industrial buyers are increasing purchases, when coin demand is accelerating, when mint production is falling behind. This intelligence is not published. It is shared in relationships. Verification methods for market intelligence separate signal from noise. Cross-reference dealer commentary with mint production data. U.S. Mint publishes monthly Silver Eagle production numbers. Compare against historical averages. Cross-reference with refinery utilization rates. Industry publications track operating capacity. Declining utilization during rising demand indicates supply constraints. Cross-reference with import-export data. U.S. Geological Survey. Customs data. Shows physical flows between regions. Identifies where metal is moving. And why? Multiple independent data sources pointing to same conclusion. Validates the signal. The concluding framework is not a prediction. It is an observation of current conditions and a methodology for responding to those conditions. February 14th, 2026, presents a $9 to $14 gap between paper price and physical reality. That gap is information. What an investor does with that information depends entirely on their risk tolerance, time horizon, capital availability, and conviction in their analysis. The difference between analysis and advice is critical. Analysis states premiums are historically elevated, supply-demand fundamentals are tightening, institutional positioning suggests price suppression, physical delivery risk is rising. Advice states you should buy, or you should sell, or you should wait. This is analysis. The decision remains with the individual because the individual bears the consequence. But the question that separates strategic thinkers from reactive investors is this: do you believe the spot price, or do you believe the premium? Do you trust the futures contract, or do you trust the dealer who must deliver actual metal? Do you position based on what the screen shows, or what the vault contains? February 2026 forces that choice. And the dealers, raising prices as spot falls, have already made theirs.